What are some of the surprisingly good things to say about the housing market? Hi, I'm Jeffrey Roach, Chief Economist for LPL Financial, and in this Econ Market Minute, I'll give you 3 highlights of the past week and 3 potential market movers for the week ahead. So let's start with the 3 highlights from this past week. First, the July National Association of Home Builders housing metric fell the largest in 1 month since April 2020 and now hit the lowest level since May 2020. Regional variations within the NAHB explain a lot. The West region continues to feel the impact of waning housing demand as workers benefit from flexible working arrangements. As of July, the Southern region is 12 points ahead of the West, the highest gap since the beginning of the regional index. Most concerning, traffic of prospective buyers fell the lowest since May 2020, suggesting that the housing market has more downside to go as interest rates are trek higher and inflation chisels away consumer purchasing power. The residential real estate market is not necessarily collapsing, but all this hinges on the duration of inflation pressures on home builders from high raw material prices and tight labor markets. Some raw material prices are already recently off their highs, so this should bode well for builders in the coming months. So we have a lot to do here. Second, the housing market still is processing this new regime of higher borrowing costs, high inflation, weakening consumer demand. So although the outlook is bleak, a vast majority of existing homes sold in June were on the market for less than a month. This indicates some lingering demand for home buying in the midst of a slowing economy. High borrowing costs will squelch loan demand. Mortgage applications are now the lowest since early 2000, so it's not surprising that all cash offers will likely stay elevated as rates spiked this year. Some cash buyers are most likely investors, but also buyers who are moving from higher priced areas such as the West to lower priced areas such as the Southeast. The real estate market is still adjusting to the hybrid work environment, giving workers greater flexibility in living arrangements and locations. But given the time required for residential real estate markets to adjust, we may see this housing slowdown phase continue throughout the rest of this year. Third, the Conference Board's index of leading economic indicators for June is not telling us anything new. Economic activity is slowing, not plummeting. At 117.1, the current index value still stands 4 points above June 2019. July data is more important. June data at this point, since many factors in the global economy shifted throughout the last several weeks. Commodity prices are much lower now. Supply bottlenecks are less impactful, and the yield curve inverted. The economy will most likely take the upcoming Fed rate hike in stride, but as the economy becomes more vulnerable, the probability of the Fed breaking something increases as the economy moves into 2023. How about 3 potential market movers as we preview the week ahead? Beside the 3 market movers in this coming week, investors will also get an update on consumer confidence for July. This stat didn't make the cut for my top 3 potential market movers because of what I'm about to tell you. So here's something that is often overlooked by the plain vanilla data junkie. The Conference Board asks those surveyed about vacation plans, but unfortunately, this vacation stat is tracked every other month, so we will not get an update this time. Consumer confidence often tracks with retail gas prices, so we could see some support for the consumer as retail gas prices fell from the mid-June peak. So first and foremost, in the event of the week, the individual in the spotlight will be Jerome Powell, chair of the Federal Open Market Committee. No surprise here, but the committee will most likely increase the upper bound of the Fed funds target rate by 75 basis points to 2.5%. The markets were temporarily pricing in a 100 basis point hike, so I do not think the markets will be overly spooked by a well-telegraphed 75 basis point hike. Second, investors will get a first look at the nation's economic growth in the second quarter. Just like in Q1, ignore the headline and look at the underlying details. So if you remember the Q1 growth estimate, which was skewed downward because of net exports, Q2 will likely have downside risk from shrinking residential investment as the housing market weakens. The markets will likely be happy with anything above zero. Given high inflation, real economic activity was probably fairly stagnant in Q2. Third, investors will get a more comprehensive measure of personal spending and personal income. Earlier each month, investors can read the Census Bureau's release on retail sales. As we get later in the month, the Bureau of Economic Analysis puts out their comprehensive report on spending and on income and personal savings. Investors, central bankers alike, calculate the deflator out of this report, and the PCE deflator is the Fed's preferred inflation gauge. There are other big releases in the week, including the latest sentiment readings from the University of Michigan, trade balance data, Federal Reserve surveys, as well as initial jobless claims and continuing claims. But these won't be front and center like the three items I highlighted. That's all for now. See you next time for more economic insights for your week, and be sure to follow me and the rest of the LPL research team on social media for regular global market updates.